Hello, it's week 27. Thanks everyone for tuning in. So, what do we have on the agenda? Mostly it's going to be about the markets. We'll talk a little bit about our firm and our updates, and we're going to talk about what our model found last week and earlier into this week. Kind of interesting. And so, we're going to start off with some context. So, one of the things that actually, I was looking, if you type in COVID-19 update for Illinois and you change it up for the whole country, you'll see that the number of new cases keeps rising. So we were down to like single-digit thousands in early June, mid-June, and we've come up to 23,000. And that's high. That's above the 7-day average, so we're growing. And we look at people who've died from the COVID, you see that number has risen and is coming up. And so, when I saw the market correct this week, I thought to myself, maybe it's COVID. Maybe people are worried that we're going to go back to lockdown. And so, good news is it's the summer. People are outside. We're probably okay. But as we head into the fall, it's probably not quite as good. And so, never good when you see this line starting to trend up. And then I'm reading things about all the different variants, and I'm not sure I understand it, but I could say that people might be worried we're going to have another issue there. And that actually could have driven one of the things that I tweeted about a lot this week was the 10-year bond yields. And so, we could look at all the different yields. But if you go to a year, you see how we've come down. We came down below 1.3% 10-year money. And so this is challenging, right? Rates fall. This should be great for the stock market. Oh my God, it should be amazing because money's cheap. But in fact, just the opposite. While the 10-year was coming down, and I'm going to show you how I do this stuff. And this is also a 50-day moving average exponential and a 200-day moving average exponential, so they don't cross quite as quickly. We're going to do a 1-month look, and we're going to compare it against the spider, the S&P 500. Yep, we'll make it blue, and we're going to compare it against QQQ. We'll make that purple. And by the way, SPY should not have a dollar sign. So sorry about that. Keep thinking about my social media work. And so what we see here is the markets, actually you don't see much anything. Let's look at 5 days. So as the interest rates came down, the market came down. So something happened right around that morning of the 8th. And honestly, I never figured out what it was. But it took the stocks down. It also took interest rates down, yields down. Because otherwise, you see the market was actually looking like, a little bit down, a little bit up. It was fine. It was within 1%. And then it was down, and then it kind of creeped down and creeped back up. So as did interest rates. But the question is, what drove the rates down? What happened? So I honestly don't know. I thought maybe it was the COVID, but maybe not. So let's take a look at the executive order. It could have been this. So there's an executive order promoting competition in the American economy. This was signed by our president, President Biden, and I saw some tweets on this. This was talked about before it passed, so this could have had an effect on the market. And so it starts by making a case that says corporate consolidation has been accelerating. So in 3/4 of the industries, fewer companies control a larger percentage of the business than they did before. Okay, well we can argue that's not good. That lack of competition drives up prices for consumers. This one you kind of have to make an argument for, because we have no inflation. So as fewer players control more of the market, markups or profit margins have tripled. So I might argue that that isn't because of consolidation, but that could be because of scale effects. That could be because of efficiency and productivity, the use of technology, cloud computing, employees working from home, fewer employees because of the COVID. And then they talk about families are paying higher prices for necessities. And again, with inflation running at 1 or 2%, hard to justify that, but that's fine. So then they're driving down wages as well. And so they point out not the productivity argument, that as productivity increases, wages increase, but the competitiveness of labor. Right? If there are fewer employers in town, employees have less opportunity to bargain. Well, I don't know. This one feels like a step back in time. I think about I live in Illinois. I live near Chicago, and there are only a few employers in my town of Highland Park, but it doesn't mean I can't head over to Lincolnshire or Northbrook or Lake Forest, and there's plenty of good jobs, all around the area. But I guess for people maybe who don't have a car, who ride their bicycle to work or walk to work, it's definitely tough. And but just it's just interesting. So it's hearkening us back to a day when people packed a lunchbox and walked to work. They're arguing that lack of competition is costing the median American household $5,000 a year. Okay. So we're going to go after it. We're going to decisively, basically fight and go after. We're going to go do antitrust legislation. We're going to do enforcement actions. We're going to break apart large companies. We could challenge bad mergers and bad acquisitions of companies and maybe break them apart. Now, I have to think about that because, like IBM bought Red Hat. And if you tried to break that apart now, I'm not sure what happens, right? Because those firms are fully integrated. And they weren't challenged before, so should have been fine. That's okay. So let's take a look at where we're going to focus. We're going to focus on labor markets, which, again, goes back to the labor argument, agricultural markets. So we're going to focus on making smaller farms, smaller food production, smaller dairies, granaries, meat processing. Okay, I don't know much about that market. Healthcare markets. Prescription drugs, hospital consolidation, and insurance. Now, this one's interesting because it says, as companies have consolidated up hospitals, which I thought was a good thing because it aggregated purchasing power. One hospital does not have a lot of competitive power. 50 hospitals? Maybe it does. Maybe you get the best doctors. I know for myself, I belong to this thing called North Shore Medical Group, which is Northwestern University. There's a University of Chicago one, but that's different. So North Shore. So I get access to doctors and hospitals in a whole network. So if I've got, God help me, right, a cancer or something, then I have access. I thought was better, but maybe it's better if I could just go to a small hospital and I just hope that they have the expertise I need. Maybe I just go to experts. Like when I had my knee done, I went to the orthopedic surgeons that take care of the bears. And we're going to go after the tech sector. So, okay. There's going to be a new competition council. A White House competition council. And so I'm a little nervous, right? So encourages the FTC to limit or ban non-compete agreements. Okay. Ban occupational licensing restrictions. Now, this is interesting because, like in Illinois, you want to be a hairdresser, you need a license. You want to be an accountant, I believe you need a license. Do you know if you want to be a financial advisor in the state of Illinois, you need a license. You need all kinds of stuff. And so if maybe we didn't have all those licenses, we could expand faster. You know, on previous videos, I talked about getting a state of Illinois license and then maybe FINRA or SEC. Well, the reason you have to do that is if you have 5 or more paying clients in Illinois need a license. Okay, well, that protects Goldman Sachs, right? It doesn't really protect me. It does protect the consumer, but, maybe buyer beware, right? Prescription drugs. So we're going to go after prescription drugs. We're going to force competition. It's interesting. I don't know that I understand a lot of this. So a comprehensive plan within 45 days to combat high prescription drug prices. So now, let me tell you why this is a very dangerous thing. Okay, so I have investments in 3 companies that invent drugs. And I'm going to tell you the story of one of them because it makes me sit on the edge of my seat. So here's a stock called Corbis. And I'm going to put that next to AKBA. And I'm going to put it next to Satsuma. So these are my stocks. These are stocks that I have my own money invested in. And they develop drugs. So let's go back for the view over a year. So if you would have invested in these 3 companies, you would have spent whatever, $1,000, and your $1,000 would be worth around $300. So you would have lost 70% of your money investing in new drug companies because it's hard to make a drug. You raise the money, you do the research. And by the way, it looks like they moved together here. And then pow, September 8th, your companies are worth 80% less. So it's different. If this was like breaking rocks or manual labor or going to the gym and working out, then you could say, you know what, let's use the gym analogy because I've been working out lately, feeling good, feeling very muscular, right? But the gym doesn't require the same type of analytics and risk-taking as drug discovery. You could have a tiny thing happen and an adverse effect. There was a drug that came out that today the stock dropped like in half because they tested the drug on 3 people and one of them got sick, had a serious adverse effect, SAE. Well, their drug has been stopped. Their trial's been stopped. Boom! Stock has dropped. So it's very risky. And so when one of these 3 drug companies has a successful drug, so we're not talking about like Viagra here. We're talking about Satsuma treats migraines. AKBA treats kidney diseases, including anemia that's caused by dialysis or sometimes not by dialysis. And CRBP, Corbis, which is trying to cure cancer, fibrosis, DM, and immunosuppressive diseases. And so these are things that really hurt people. So I would expect them to make a handsome profit if they survive. Because as an investor, I might have lost 75-80% of my money while I wait. I sure hope they're going to make a profit or I won't invest in them. And so what happens if I and people like me don't invest in these drug companies? Well, I'll tell you the story about Satsuma. Satsuma was running out of money. And so they asked all their previous investors to basically double up. They didn't have to, but please, at $5.68 a share, please buy more. And all of them but Morgan Stanley bought more, and it kept the company alive. The company, I think, now has maybe 1.5 years, 2 years worth of money to do its drug research. So, but if there's no profit at the end, they might have said, you know what, I saw this executive order, no thank you. The people who work for Satsuma are unemployed now. Maybe they go to a big drug house like Amgen. Maybe they're lucky to get a job. No one's getting rich, though. And Amgen might say, you know what? This is very risky. You're giving me weird stuff here. I'm going to invent a new drug. I'm going to take a risk. I got a better idea. I'm going to go to the gym. I'm going to lay off 20% of my workforce. I'm going to force people to work harder, and I'm just going to make more profit on the drugs I have. And let's be honest, there was no cure for migraines or for kidney disease. And whatever we got, it's good enough. The government says I can't raise my prices. We're fine. We're fine, Jeffrey. Come on. Leave me in peace here. I don't want to take the risk. Same thing happened in semiconductors, which is why we have a chip shortage. Same thing happens in many industries. Whenever you start to look after that surplus profit, what you're not really looking at is the surplus cost, the high risk of investment. And so, honestly, I just need everyone to think about this because this is brand new, right? Hearing aids. Hearing aids are so expensive, right? $5,000. So you know what? I'll tell you how you solve this. I have a friend of mine, Seamus Hurley. Seamus, how you doing? So Seamus invested and is a board of directors member of a firm that's solving this problem. They could provide hearing aid equipment, hearing aid, at more of like what I'd say a retail or consumer level. It's probably good enough for most people. It's like $1,000. So guess what? We could have a law that goes after hearing aids and says, you know, the hearing aid people need to lower their prices. The 4 largest hearing aid manufacturers now control 84% of the market. You know, competition has a way of really fixing things. If this new startup, he showed me them. They looked really cool, actually. It's like $1,000. It's a little box. You put them in your ears. You got an app on your phone. You do a whole bunch of things. And in like 15 minutes, you're hearing great. That's how you solve this problem, maybe more than legislation or executive action, right? So, okay. So proposing rules for allowing hearing aids to be sold over the counter. So now there's no hearing doctor involved. Okay. That seems weird to me. I don't. Maybe. Insurance, health insurance, transportation. By the way, you want choice in health insurance? The reason that there's been consolidation in health insurance, come on, United Health Group and such. And by the way, I'm sorry if this sounds political, I don't mean it, but the reason you have consolidation in health insurance is because you're competing with the federal government. You have to be big. You have to be powerful. You have to have scale. You have to have systems, probably $1 billion IT systems to manage all that data, so that your call center people can see the claims and can see the payments and can see the hospital information. And the hospitals can connect seamlessly with the insurance company so you don't have to retype and make mistakes. All that IT glue is expensive. And so, yeah, you need scale. Nothing's stopping a new company from offering insurance. I mean, just so this to me makes me nervous because if I'm Amazon, if I'm Google, if I'm Facebook, if I'm Twitter, if I'm IBM, if I'm Hewlett-Packard, if I'm any of these big companies, then I think to myself, we need more competition. And what does that mean? That means I got to break myself into pieces. Or maybe I got to focus on the most profitable niches of the market and stay away from the risk. And so we could shrink down our own companies to do this. It's just so interesting. So I think this could have been one of the things that drove stock market down. By the way, I'm sharing the thing about the stocks I'm in just to kind of give a lesson here, which is no risk, no return. It's very risky to invent a new drug. The payoff is tremendous. It's amazing. You get rich if you pick this right, but you go poor if you don't. And so it's a lot of science. It's a lot of experimentation. Just gonna share a little bit. We are on Twitter, and we're seeing a lot of things on Twitter that are interesting. One of the things I want to call out, and this is around quantum computing. It's Dana Anderson, right? So good job to the Cold Quanta team. Dana Anderson and team. I've met Dana. Dana's great. In fact, Cold Quanta helped us when we were looking for a second grant proposal. 100 qubit processor. So Rigetti has said 80. They got an 80. These guys have 100. 2 to the 100th. 100 stocks. There's a lot of ways to think about it, right? We're still not at the point of beating my my Dell, which, by the way, thank you, Dell. Great computer. But you get closer with 100 qubits. You're getting closer. You're doing better, right? And so, yeah, you see a lot of motion here. I love it. Love Cold Quanta. Love what they're doing. I like the people. I've met them. They're great people. So, and on the tweet deck, just to show you, right? So we're all waiting for our drug stocks to go through the roof, and there's no news. No news. No news. You look at Auto, which went up today, Auto Web. There was news. It was great. There was actually some really good news on AutoWeb. They had some public relations, and then Zacks came out and said some nice things about him. And so you get a little bit of news. It's nice, right? This is the stocks, a different way to look at it. I'm showing you how I keep in touch with different stocks. And so here you see, AutoWeb is at 295. I mean, who knows if that's good or not, but I like it, right? Satsuma, very interesting this morning, decided it was going to climb to $7.33. I think it hit $7.40 today, and then it came right back down to the $7 line. So I love Satsuma. Just so you guys know, it's truly a value stock with huge potential. These are our 4 stocks, right? AutoWeb, Corbis, Satsuma, AKBA. AKBA fell out of bed. Look at this thing. In a week, it was in the $4 range, and it just fell out of bed. 362 down to the 330s and 340s, and there's nothing we could do about it. I mean, it dropped. I could have sold it, I guess, at 4.25. But AKBA has revenue. There's money coming in. It has 1 drug that's been approved. It's got a second drug in FDA approval process. I mean, it's a good opportunity. And the CEO isn't. Where am I going to find what I posted? The CEO is actually posting things that are of good cause to the people. I'm not going to find it. But net, he's talking about kidney health legislation that's before the House right now. There's a bill, whatever, looks great. He's not just pumping his own company. He's actually trying to help people with kidney diseases, and I think that's terrific. So that's what I saw there. As you know, there's our website, right? Chicago Quantum. And I think what's going to happen is we're going to shift more towards the financial services and towards data analytics and less towards, let's say, hard quantum. But then all of a sudden now we're doing this research. And I showed you this chart last week. It's more advanced now than it was before. We're making a ton of progress, right? These are the firms that make up the quantum industry. And I know last week I talked to you about the overall investment level. And as we've started to dig a little deeper, the companies that we thought had raised a couple of $1 million, no, they've raised a couple of $10 million. This is a totally different game now. The quantum, the people who are making the hardware and the leveraged software are, we're talking $5 billion. Just numbers I can identify with a press release, an article, something about venture cap. You get $5 billion invested. It's a lot of money. The game is different, right? We're now kind of entering into a very interesting time for quantum computing, and some of the numbers are fairly dramatic. The largest investment, look at this, Quantum Computing Inc. Has 0 revenue. I'll show it to you. Quantum Computing Inc. QUBT. And I know the guys. I hope that's what it is. Here it is. Quantum Computing Inc. I know the guys. It's a $150 million market cap. So figure they raised $150 million. Okay, when you go to the financials and you look at the income statement and you look at it annually, you see zero revenue. Zero last year, zero the year before. You want to look quarterly just to make sure, a whole bunch of zeros, right? So they don't have any revenue. Even my firm has revenue. What the hell are you doing? Go get a client. Go talk to someone. They just hired a guy, Joel Gottlieb. I love Joel. He's amazing. So good at D-Wave. Technical, brilliant, nice with clients, but no revenue? What's he doing? Kind of hanging out, I guess? Like hanging out with people? I don't know. Maybe he's writing a manual or something. But so no revenue, $150 million of investment. It's just one that I found. It's just so interesting, fascinatingly interesting. But then here's the other one that, just to bring it up again. So Honeywell is spinning off its quantum business with Cambridge Quantum Computing. And the CEO of Cambridge Quantum Computing becomes the CEO of the new business, with Honeywell Quantum Solutions CEO Tony Utley will be the company president. And Honeywell CEO Darius will be the chairman. That's $700 million. And just other firms like Intel, I didn't know Intel was doing this. So I looked at it, and Intel, they basically donated or committed $50 million to the students at TU Delft and to the faculty to use the chips. I figure they spent $50 million on themselves, and this is at one point in time. They probably double over time. So you figure $200 million by Intel to create great chips, right? Xanadu, I'm afraid to look at their revenue. Maybe it's couple $1 million, and they raised $145 million. Google AI, we're estimating, spent $200 million. Total swag. But for years, they've been funding teams. UC Santa Barbara and others. They were the guys who were running the D-Wave experiments with USRA at, I think that was NASA Ames. Yep. Just so much. So many brilliant people at Google AI. So now we're up to $5 billion invested in quantum. That's real money. And we still have work to do. We're still working through this. And I'm discovering new firms. So the quantum industry has firms that are kind of quiet. So here, Quantum C-Tech. It's out of China. They claim that they have run the Google quantum supremacy experiment, only they had a bigger chip, more qubits. I want to say it was like, instead of 53 qubits, they had 60 qubits. So they ran it on 56. I don't know that that's exactly the numbers, but there's a link there. Something like that. And they won, and they beat the Google results. So I figure they probably spent about $40 million for this whole company. You know, it's China, that the dollar stretches further. But they're really good at quantum key distribution. They have a production license from the Chinese government for commercial encryption products. And they're doing short and long haul networks, long distance networks, with quantum key distribution safety up to 6,000 kilometers. So let that sink in a little bit. That's here to New York and back through a diverse routing. Totally secure. Can't be broken. Now we've got a black spot where no one can see in. We have a network from here to New York and back, or maybe here to New Orleans and back. And so they're making the equipment that do that. So you talk about commercial security. That's great. Well, I never even knew they existed. Now here's another one. Hughes Research Lab, HRL. I don't think it's actually called Hughes Research Lab. It's just in the memory of Howard Hughes. I didn't know. They got their first patent in 2020. They have 1,100 patents. They are hiring at all levels for its quantum science program. And I mean tons of hiring. I want to say dozens of people in quantum. I never even heard of them. There's another $50 million. right? I mean, just Goldman Sachs, 10 million. Ford Motor Company, 10 million. BASF, 10 million. Quantum, I love this one. Quantum E-Motion. It's cool. 60 million bucks. By the way, they have $221,000 of book value. So you're paying a healthy multiple to book. What is that? That's 300 times book. A little crazy. But so this is what we're learning. Reply. I heard a Reply when I was in Europe. They used to advertise on the pop machines, the soda machines. They're all over. They're printing their ads on bus stations and bus stops. They're a system integrator and consultancy. Well, they created a quantum computing center of excellence. They won the Airbus challenge. By the way, this is the part of the Airbus challenge that we competed in. They won it for airplane cargo loading. They have quantum solutions for clients. This is crazy. This is real money going into real businesses, developing real solutions in quantum. Guys, I think this is terrific. I think everyone should take a moment, give a little round of applause for the quantum industry. Say we're up to 5 billion. That's nice. That's a lot. And so we're going to be tracking this now. And now you start to see some investment situations. You see companies that are now listed in the stock exchanges or over the counter that are focused on quantum or quantum inspired. So I love this. We continue to work on this. I'll make this available to paying clients. So if you run a job, let's say, or you decide to buy some hours from us, we'll share the table with you and we'll talk through the clients. And so I think it's good. Now that you know we're not giving it away for free, hopefully you did a couple of screen prints there. But we'll keep updating that. And it's not expensive. We just got to stay in business. So for a couple $1,000, we're happy to work with any company just to get started, give them an overview, maybe walk through the models. And from there, we can help you make money. That's how it rolls. So, okay, that's good news. So I want to share that. Let's talk about the market. There were some weird things that happened in the market this week. So we're going to start with the S&P. There it is. 5 days. 5 days, interval, every 4 hours. And what you see here is not AKBA, no thank you, and not Satsuma anymore, but just this. So what you see is we had flattened. You remember we had talked about that. And the market climbed again, and then it corrected. And now it's back up again. So we're still moving up. Maybe that period of flatness, look at that. From flat to wow, right? Just wow. That was flat. Now we're back up into wow again. And so maybe this little correction felt painful, but really wasn't. Really was no big deal. I'm guessing if I look at the NASDAQ, I'm going to get the same answer. It'll be different, though, for the Russell. Look at that. Flat as a pancake. And now all of a sudden, it's rising again. The NASDAQ had a hiccup, right? But right here, what we're really seeing is it's climbing again. So that's interesting. Let's go back and let's take a look at the Russell 2000. Now, the Russell 2000, kind of when you're in the fray, you don't really understand what's happening. So take a look at this, though. So the Russell really is, we're going to do a 1 day. Just want to show you how to analyze it. Let's do 1 day, 1 year. Okay, so it's a daily interval, and I don't want to do colored. Let's just do area, okay, just to make it really obviously visible. So you look at how this was September 2000. We're going back here to July of 2000. So it recovered. It kind of came down a little bit. It recovered. It came down a little bit. It likes to correct itself. You see that same pattern here. A little correct, a little correct, a little correct, a little correct. And then lately it's been pretty flat. Now all of a sudden there was a little dip there. Nothing abnormal, right? And so if we zoom in and we try to take a look at that dip, what I thought this was maybe some investments, some bets against the futures. The Russell 2000's options, right? You can imagine, right? Let's drive it down here. Let's drive it down here. Let's see if we can cause some momentum to happen. And then once you drive the futures down and make the bets against the futures, you start to drive people to have to cover an arbitrage and look at all the stocks. And so maybe what happens is you sell the futures, and now somebody else goes out and sells the top 100 stocks or a couple of the stocks that'll drive the index. Now, by the end of the day, you're buying it all back. It's fine, but you do see some of the weaker hands, the weaker stocks, the weaker holders of stocks, the people on margin, they get shaken out. So when the price drops like this, if someone's on margin or someone's a nervous holder, they sell. You remember the old saying, right? Cut your losses and let your winners soar. And so cut your losses. That's a great idea. But then you're out. And you're out just before it recovers again. And so I struggle with that saying, by the way. I am holding my winners in the hopes that they keep running. But sometimes right when the stock goes down, there's a dip, you buy it. You buy the dip. You average your cost down. So there's a lot of challenging right there. But so then I saw something else that kind of freaked me out. I saw the dollar. So dollar euro had some corrections, had some issues there. Take a look at that. This is the number of dollars it takes to buy a euro. So when the thing goes down, it means the dollar's stronger. So this is on June 20th, the dollar strengthened, which is weird because our interest rates are lower. But I think this is when the whole taper tantrum started and the whole issue with inflation and where are we? We're nervous. But also the U.S. economy started showing signs of life. And so strong economy, low interest rates. I'm not sure that's the best thing for the dollar, but we saw the dollar strengthen. Then it weakened a little, gave back a little bit of the gains. Boom. So by now, by July 7th, the dollar's pretty darn strong. $1.18. We haven't seen a $1.18 since April, since March 30th. And we haven't seen it since November 1st. So November 1st, March 30th, yesterday. So what happened? Well, I'm not sure, but I will tell you, I always get nervous when the dollar strengthens because it's harder for us to export. It's easier for us to import. And so, about all I can tell you. Now we look at the treasuries, and we see, of course, the treasuries were down. They came up. They were running a little flat. What we see here is the treasury yields are actually dropping. We had treasury yields right there at 1.288. They reached a low of 1.27. That's 1.25%. That's low. Right now, it corrected. It came back up a little bit, right? It's hard to move a market that's this large without a little correction back or snap back. But what you see here is if the market does not require more than 1.25 or 1.35% for your money for 10 years, it means you got nothing better to do. You don't want to be in stocks. I mean, if you want to be in stocks, it's great, right? Because you're not giving up much interest to be in stocks. You don't want to build a building. You don't want to build a house or a bunch of houses to sell. You don't want to build a factory. Well, why would you? Well, now there's executive actions coming after you. Or maybe it's the consolidation means we don't need as many buildings. But I don't know. We're just not investing in the same way that we were investing in the past. And so we're not investing. We are driving down interest rates. The money, I feel like the money is just being parked somewhere. Maybe that's as people get wealthy. Maybe this whole thing they talk about with consolidation of wealth, it just sits. Look, if you got $1 billion, you don't even really need to invest it. You stick it in a bank. Every bank in the United States could have $250,000. So you're in FDIC, coverage, and so now you got $250,000 in every single bank in America. That's terrific. You don't even have to move it, touch it, right? So now let's take a look and see, did the velocity of money go back up? I look at this a lot because this is really the crystal ball. Nope. Still 1.122. Still at, it's never, other than Q2 when it was 1.103 versus 1.122, which is about the same anyway. We haven't been this low like ever. Like since they started collecting the data. I mean, normally you're at like 1.8. It's been over 2. So money's not moving, guys. Money's staying still. Maybe it is the consolidation of wealth in the hands of a few. Maybe it's just people don't know where to put their money. Maybe they're scared of regulations. I don't know. What I know is money's not moving. By the way, this is what you look at if you want to find inflation. This doesn't cause inflation. This soaks up inflationary pressure. So when the velocity of money is falling, and I'm sorry, people without like a PhD in economics or whatever may not get this, but I keep covering it week after week because I want you to understand it. Inflation is based on money, but it's not just printing money. We print money all day, but it's printing money multiplied by the velocity of how fast that money moves. And so if the velocity of money falls by 30%, then you could print 30% more money. You kind of have to in order to keep prices stable. So this is what I look at. God help us if the velocity of money pops back up to historic average of 1.8. There's a building frenzy. The economy picks up. We want to put everyone back to work. That infrastructure bill they talk about, right? We start building up rural communities. We start building up. I mean, we're going to Alaska, and there's towns with 80 people in it, right? Well, guess what? They don't have any roads. They don't have roads. We're going to go to Alaska to places where there's no roads. We're going to walk or take an airplane and drop in like Walter Mitty to the water. I hope I don't have to jump out of the airplane with my backpack because that would be scary because the water's cold, but I guess if I have to, I have to. There's no roads in Alaska where you want to go, right? And so maybe we build a road. So maybe the velocity of money goes back up. Because now I got to buy equipment, and I got to hire people, and I got to have materials, and I have to start doing things that take a year. Building a road takes a long time. But until we see that, as long as velocity of money is around 1.1, yeah, there's not really a concern about inflation today. So we talked about a few things here. What else did I see in the market? So maybe it's just being too close to home with all of this. But I follow a certain number of stocks. And it's nice, right? Because some are up and some are down. But there were days when everything was down. Gold was down. Oil was down. Bitcoin was down. And all the cryptos, right? The markets, the foreign exchanges were down. The foreign stock exchanges were down. So it's nice to see when things go back up again. If we go back to the Russell, right, was it even a blip on the 5-year chart? Tiny blip on the 5-year chart. Let's look at the 1-month chart. I mean, there's a blip there, but it's normal. So the next time your stocks drop a couple percent, just don't worry about it. You're going to be fine, right? I mean, I guess we can always be thinking it's the end of the road, but because at some point there is an end of the road, but you drive a long time before you get to the end of the road. And so what I showed you on the S&P and on the NASDAQ is those are back on an upward track. The Russell is flat. So what this really means with the Russell being flat, What's it mean, Jeffrey? Talk to me, Jeffrey. What's it mean when the Russell's flat? Well, the Russell's not really flat. Russell's been going up a lot. Let's see. Has it been flat for... There. Flat for a week. Even Russell 2000 isn't flat. I mean, it's kind of flat when you look at it, right? But looks like it's finding ways to reach highs. And so, I don't know. Not that scary of a market. Just more volatility. Just more ups and downs. And that's just the way it's going to be. So I promised you I'd talk about what the model found. And so the model has been picking, roughly speaking, the same stocks or the same types of stocks for the last few weeks. And what does it mean? It means that stocks have been trading in a pattern. And they're really not breaking out of the pattern. We also see more and more consumer defensives, telcos showing up towards the top of our model. So that's something we see. We see a lot of pharma, biotech and pharma coming into the model. We see food and beverage. So we're starting to see some of those larger caps come up. And that's always interesting. So finally, what can I leave you with? I guess I'll leave you with a thought, right? So let's say you own a stock. I'm going to pick a stock. Satsuma. So you own Satsuma. Hopefully you didn't have it when it was in the 20s. But maybe you did. But maybe you bought it when it was 5 or 4 or 7, right? So you got the stock. And you're thinking to yourself, yeah, been pretty flat. If I look at this, it's actually pretty flat for months, right? But it's gone up, and you're thinking, all right, I'm nervous, right? So then the stock drops a little bit. We're going to look at this 1 hour intervals for 5 days. And you see, wow, that's some crazy stuff right there. Look at that spike this morning. Look at the drop 2 days ago. So just know that when the market is trying to establish its direction, you are not going to know what's going on. You're not going to know. Maybe it's one shareholder. Could be one shareholder trying to pick up some stock here. We're not talking a lot of volume even. We're talking what? 20,000 shares in a 5-minute period. 13,000. Here we're talking 25,000. We're not talking that many shares here. We're talking in the tens of thousands of shares in a 5-minute period, driving the price up and down, looks like about 5%. And so just know you got a 5% mover here. Over the long term, the thing pops up and down a lot. So I guess if you're a swing trader, this is your dream. If you're actually long the stock and you want to hang on to it, you can see that if you bought it down here at around $5, you made some money. And so what I would say is, look for news. If there's no news, look for chatter. In the chat rooms. If there's no chatter, then just know that you're looking at a stock where maybe it's one buyer, maybe it's a couple of buyers who are excited about the stock and who are getting in or getting out. Nothing you can do about it, right? And so maybe you just stay the course. So what happened to me was when the stock dropped and I thought, oh, Rome is burning, I went to the gym. Had a great workout. And then by the time I got back from the gym, the stock had recovered. It was fine. There was no news. There was no chatter. There was just a bunch of people posting memes. It's fine. So that's my thought, right? So as we're in the summer, there's fewer people trading. Maybe there's bigger swings. And you just got to be ready for it. Now, you could sell in May, as they say. Sell in May and go away, right? By the way, it's July if you didn't notice, right? So I guess you could sell in July and go away, right? But, or you stay the course. And every once in a while you get lucky, right? Because one of your stocks goes up. And I want to thank you again for listening. This is Jeffrey Cohen. If you do have a moment, please hit the subscribe button. Please hit the thumbs up button. That really helps. It tells me that you watched it and you're interested. If you hit the subscribe button, you get a notification that I'm live. By the way, I'm watching the chats. No one's chatting, but you can always ask me anything, and I'll talk about a topic. Give me a stock to look at. I can analyze a stock for you, right? I mean, I'm not Jim Cramer, but you know. And leave a comment. And if you really like the video, share the link. Just go ahead, share it on social media somewhere. But the most important thing is subscribe, thumbs up, leave a comment. Then if you really were excited and liked it, share it. By the way, we don't make any money making the videos. We don't monetize. There's no profit. There's just us bringing our ideas to you and sharing our thoughts and wisdom. Because as we learn and we collect our thoughts and we share them with you, hopefully you become a better investor. You take care now. Have a great weekend. Bye-bye.